Hello and welcome, I'm Natalie MacDonald and you're joining us for FundForum's live chat. We're coming to you live from the JW Marriott in Hong Kong on day one of FundForum Asia 2016. Over the next 15 minutes we're going to be bringing you some of the conversations, some of the hot topics and some of the debates certainly that were being had today, with a look particularly at disruption in the asset management space. This is brought to you by HSBC and you can follow the conversation by using the hashtag FFAsia16 on Twitter. So with no further ado, I will introduce you to my panel today who've taken the time to join us at the end of this very special day. Now we'll start off over here to my right and we have Jeroen Buwalda of EY. Jeroen, thank you so much for taking the time to chat with us today.
You're welcome. Yeah.
We also have Konyn to my left, who is from AIA Group. Thank you very much also for your time.
Pleasure.
And lastly, but by no means least, on the end, I'm joined very much by Malik Sarwar of HSBC. Gentlemen, thank you very much for the time. And I think a toast firstly to congratulations to a very successful first day of FundForums.
Yes.
Now, one of the items, as I mentioned, that we are looking at today is disruption in that asset management sector. And one of the things that was interesting that came actually from audience feedback is that we had 40% of our audience today actually saying that regulators were being the biggest disruptor within this space. Now, Malik, I know you were present when these announcements were coming through. Tell us through your thinking.
I took exception to that. And if this were a democratic process, we would have to listen to the audience. It was the majority. But I'm going to be the Donald Trump today and say, that doesn't matter. What I'm going to tell you is the truth, which is that I think the regulators are really enablers trying to help the industry get back on its feet after it lost some credibility after the 2008-9 crisis. And maybe the concept of disruption means we have to add layers of reporting, the paperwork has become more cumbersome, enhanced due diligence, etc. Clearly that is painful, but it is a step in the right direction to help clients with trust, transparency, fees, etc. So they clearly are partners, albeit they may get a little exuberant at times.
And Mark, when we sort of discussed this prior to this chat, you took umbrage somewhat to the idea of regulators being disruptors. If anything, kind of their role is supposed to be almost the other way around.
Yeah, sort of following on a little bit from what Malik's describing in terms of where we've come from since the global financial crisis. The industry did lose a lot of credibility. We had issues here across the region, particularly here in Hong Kong, where certain retail investors bought instruments that they didn't really understand, and when things didn't work out the way that was anticipated, there was a lot of finger pointing, and of course the regulator is front and center because the public expect the regulator to protect their interests. So I think the reaction to that was that there was a slew of regulations that came from on high, or if anything, there was a slowdown in the way that new products were allowed to be brought to market. But I think we're well beyond that stage now. So for the group in that room to suggest that regulators are disruptors, I think is a bit disingenuous. I think where we are at the moment with disruption, we're at an early stage, but of course, we have one market here in the region, one economy, which is really at the forefront of bringing technology into use in the area of wealth management and advice, which is mainland China, where the market is so vast and the opportunity for growth so extensive that there is a huge amount of experimentation underway at the moment. And I think there's a lot to learn from what is being done on the mainland, not just for the rest of us in this region, but I think much more broadly across the globe.
So, I mean, we've already had two panelists shunning the voice of the people today. Jeroen, well, what are you seeing then as being that key disruptor within this space?
So first point I'll probably make in response to the comment is that I interpreted that as the regulators disrupting the disruption. So I think there's significant barriers still for disruption to take place in Asian markets. We've got fragmented markets across Asia Pacific. We've got lack of standards. We've got onboarding processes that are very cumbersome. So all of these ingredients are not the right settings yet for some of these Roboadvisors or robotics or bots to flourish. So hopefully they can play a role in trying to lower those barriers to entry, which will enable a lot of more innovation and to come into the market. If I just look at what is the highest potential technologies to disrupt our close to $160 trillion industry globally, then there's probably four things I'd call out. So robo-advisory at the front end, which will have a real potential to change the way in which advice is provided. I think they won't replace advisors, I think they will augment them. I call out robotic solutions in the middle offices. I think we all should be worried about that, because McKinsey, I think, said in November last year that 45% of all work activities can be automated with already demonstrated technology. And then towards the back end, I think blockchain is a great technology that again, might be might pose some existential questions to asset servicing companies.
Now, I brought up Roboadvisors in one of the conversations today. I was interviewing Hendrik Jotois, CEO of Investec Asset Management, and I uttered Roboadvisors, and he groaned. He audibly groaned, because I mean his argument was that at present he can't travel to the US without his credit card being stuffed up through an online service. So really, why would he trust an online system with his portfolio? And the idea of this fintech development that we're seeing is that yes, that software is fantastic in terms of back office scenario and being able to help sort of behind the scenes, but in terms of those frontline services, you're going to struggle to replace an actual person.
That's missing the point, I think, and Malik will have an opinion about this as well, but it's missing the point, because it's not about replacing humans. I think robo-advisors are much more powerful when they augment them, when they help them. Just think about going to two different advisors. They could be of the same company, they could be in the same street. You go with the same set of questions. What's the probability of getting the same answer out of them? It has to be quite low, because the discussion will go in different ways. Now, if you've got a robo-advisor supporting the advisor with the same rules, the probability of getting the same answer, which is in the best interest of the client, has to improve. So,
and actually, just to add, decades ago when bricks were prominent and clicks, internet came to being, the view was banks will close branches because it'll all be clicks. It became bricks and clicks.
I agree.
And the old saying, you can't fax a handshake, or you can say you can't email a handshake. So it's not either or, it's actually and. And a lot of the robo-advisory bit is a consistency how clients get information, because clients are looking for SLY product, safety, liquidity, and yield. And based on the risk profile, it could be more yield and less safety, etc. But within that, the consistency provided by robo-advisors helps RMs be more consistent and the institutions more consistent with how and what they're advising their clients on.
What, just as a query, I'll come to you, but in terms of these robo-advisory services, for example, I'm based out of Sydney, and when you've got self-managed super funds and you've got a lot of people wanting to look after their own funds and their own money and their own portfolio, the robo-advisory has actually already had some level of liftoff from there. But what are the type of clients that it does actually service?
Maybe coming firstly back to Malik's point, I think using it as an augmenter is sort of enhancing the distribution pattern that already exists in the market. And I think the real challenge for the industry, as has been raised by the regulator here in Hong Kong, is how do we move beyond the current limitations of our distribution? There's a huge amount of almost criticism, which I think is a little bit unjust, leveled at the retail banking sector for dominating mutual fund distribution, as if there's something wrong inherently in that, because there's impediments to broadening out participation in mutual fund investing because of the cost, because of the accessibility. So I think there's an undercurrent and a view, certainly within the regulator here, that somehow if technology can be applied for us to break the constraints of the current distribution pattern, somehow more investors will be able to participate and will be able to mobilize and channel savings much more effectively. And if you look at many of the challenges we've got currently from an investment point of view, it's not as if we don't have enough savings. In fact, we've got a glut of savings globally, and particularly in this region. The problem is that they're hoarded in low interest bearing accounts, and they're not being deployed and applied productively for the benefit of the broader economy. And as we know, we talked about yesterday, there's an urgent need to get money out and working, particularly for infrastructure development. So there's a breakdown in that channeling. I think the criticism that's been leveled is that relying too heavily on retail banks even augmented with robo-advice or not, we're just not going to get there quickly enough in order to develop what should occur, which is productive investment.
Maybe in response to your answer, which clients robo-advisors might target, I've actually been quite surprised on that recently, because originally I was assuming that advisor time is expensive. So human time is expensive. And on average, particularly in Australia, I used to live there for quite some time, you typically are looking at a 3-interview advice process. So you've got at least 3 hours plus all the preparation time and everything added in. So there's quite a high upfront cost to providing advice, which actually prevented from lots of other clients receiving advice, because the benefit of receiving the advice was outweighed by the cost of providing advice. Robo-advisors will lower that barrier, so many more people can participate in that advice process. So you'd expect mass affluent or mass people to be able to participate because of robo-advice. Surprisingly though, some of the work that we're doing, we've helped one of the big retail banks in Australia, and now we're helping a private wealth office in Singapore. It's very much around affluent and high net worth investors. So we're seeing kind of demand for robo-advice, unsurprisingly, right across the value chain, both from ultra high net worth investors all the way down to mass affluent.
And I think there's a reason for that. I agree with that, because I myself have my own family retirement money and some of that. When you know that you have to have a core holding which should be low cost, transparent, and it's part of a process where it's asset allocated and rebalanced, that's where this process comes into play. Then you can build alpha all around it. So it's not an either or there again, and appeals, as you said, to the high end all the way down to the people who will not normally have invested, to your point about making some money in an environment like this. So it actually expands the universe quite considerably.
Yeah. And that links in quite well with the use of ETFs, doesn't it?
Yes, exactly.
Where you've seen robo-advice married with ETFs, passive investment, to get the basic sort of landscape covered in terms of your broad asset allocation. And then, as you say, using specialist managers to try and get their incremental alpha.
Well, we looked. Again, one of the very popular panels today was actually a macroeconomic based panel, and again, that was we were talking about the disruptors to the marketplace, but obviously coming from a macro perspective. And again, it was China's growth plan. It was a lot of these macro figures. And again, Mark and you and I at the summit discussed yesterday some of sort of the next key disruptors, almost social disruptors to this space and the type of changes that they're making. What are you guys noting on that scale?
Social disruptors in what sense?
In terms of, for example, central bank rhetoric, China's growth plan, that kind of thing.
So this was more about sort of policymakers having perhaps too heavy an influence on how investors think about markets and sort of market sentiment. Yes.
Yeah. No, so social disruptors. Look, I think there are quite a few social disruptors playing out in the marketplace as we speak. I look at just the information. If you just look at information as a starting point, when people migrate from maybe rural communities where everybody knows everything about everyone else to dense urban areas, privacy restrictions go up. The more people, the more privacy. It's funny, there's an inverse correlation there. But the pendulum is swinging back. And actually because of social media. So now people have no reservations in sharing even their most intimate details with the public. So I guess that's a great disruptor, and governments are struggling with that. Traditionally, they have looked at it and saying, we need to protect data. Data privacy is the main thing we need to do. And now you see that shifting, like the Open Banking Initiative in the UK, because they're now promoting what I call private data portability, the ability for people to take their data and give it to any service provider that they prefer. So you see a real shift, I think, in terms of what the public is doing.
Do you think that's generational?
It could be. I don't know. I think I think there'll be plenty of grandparents that know that the only way to communicate with their grandchildren is by using social media. So I think the segment in the middle would probably struggle most because they're pretty time poor and still quite focused. Yeah.
Now, before we start millennial bashing again, which is what happened in yesterday's live chat, I'm going to call it a pause there.
Nothing
Gentlemen, thank you.
Yeah.
Don't
Thank you
worry,
very much.
I'm used to it. Jeroen, Mark, and Malik, many thanks for your time today, and
No problem.
we look forward to catching up with you again soon. That is all we've got time for right now. You've been watching us on day one at FundForum Asia 2016. You can keep up with the conversation. Follow the hashtag FFAsia16. We'll be back again tomorrow with another live chat, another look at some of the key topics from day 2 of FundForum Asia 2016. I'm Natalie MacDonald. Thank you very much for your company. Goodbye.